Good evening, and everybody, and welcome to the 11th edition of our Quarterly Connect webinar. Thank you for taking the time to attend this evening. We're very pleased to inform you that we've just completed 1 year since we launched our first mutual fund scheme, our FlexiCap fund, which was launched in July last year. A very big thank you to all our investors and partners. Prashant Khemka, our founder, will start today's session with an update on the portfolio and performance. This will be followed by a session by Manoj Garg, where he will speak on the growth opportunity in the contract development and manufacturing segment in the pharmaceutical space. We will have a Q&A session at the end with our entire investment team. I'll request you to kindly post your questions in the chat box. I'll now invite Prashant to start with the portfolio update. Over to you, Prashant.
Thank you, Vivek, and thank you everyone for joining this afternoon. I see that people are still joining in. I would kickstart with the update on portfolio performance. As you can see on this slide, Q2 was a decent quarter. The portfolio return was 15% compared to BSE 500 of 13.2. So the team generated 184 bps of positive alpha. While this is over the long term, this is the average quarterly alpha, but coming on the back of a difficult year last year, this certainly felt more than an average alpha for us. Last year, as I was just sharing, was a difficult year, but otherwise over longer term, the team has generated solid alpha since inception, 116 compared to 90 of the benchmark, including the difficult performance during 22. We, by the way, between our last call and this call, we completed 6 years of the formation of WhiteOak, and we'll be sharing shortly. Since inception, the performance of the team has been very strong. These are all net returns, if I'm correct. Yes, I am correct. Attribution since inception, you'll see now these are in the bottom row. As you can see, the performance is gross of fees and tax, which is what FactSet delivers. And this is the benchmark return. So 47% gross of fees and tax. And the alpha is very well distributed, as you can see from this graph. The blue columns are the stock selection alpha. In each market cap segment, since inception, the teams delivered very robust alpha. In large caps, where it is very, very difficult to generate alpha, 125 compared to 93, and similarly in mid and small also, strong alpha. This is attribution by market. This is attribution by so this is attribution by sector. Again, the same gross of fee and other costs. The alpha 47, 45% comes from stock selection compared to overall 47. So it's very good to see stock selection driving alpha. Stock selection is universally considered to be more driven by skill rather than luck. These are the top contributors over time. So you'll see names coming from a variety of sectors: Coforge from technology, Naveen Fluorine from chemicals, IPCA from pharma, Bajaj Finance and Muthoot from financials, and so on and so forth, including a new age company or a .com, or erstwhile considered as .com, InfoEdge India, which has been very long time holding for myself. In fact, going back to the days when it was considered a high risk .com company. Obviously, on the detraction side also, we have several from across sectors. Good thing to note is the largest detractor is smaller than the 10th largest contributor. The team's risk management and position sizing has worked well, and the law of large numbers has worked well, because over this time you'll see very granular alpha distributed across various names, rather than one or two names driving alpha. If it's just one or two names driving, it can raise the question whether it is a lucky streak rather than good stock selection across the portfolio. These are the top contributors. So Chola, as everyone probably, a lot of people would have noticed, has done very well, over the last 18 months or longer. But also Coforge again appearing in the top contributors. And there were several names which trailed. It was a very strong market, remember. So even names like ICICI Bank, which were up 6.5%, or HDFC Bank up 7%, because the market delivered 13% return. This contributed to positive return, total return, but detracted from an alpha perspective, and hence appear in the bottom quartile. Also, you're showing a peer group comparison. So since inception, here you'll see that the strategy has delivered, the team has delivered 17.5 for the time period that our PMS was not up and running. We have used other portfolios, including the AIF. And then if you see the slide here, so these are the different peer groups, including, so S&P 500, actually the benchmark's been a very solid performer over this 5.5, 6 years at 13%. So the most of managers have underperformed. These 10 other portfolio managers are basically all these schemes where PMS portfolios which are above 2,000 crores in market cap, in size, in AUM. There's a bit of a positive selection bias, and these are all the multi-cap PMSs, not small cap, not mid cap, not large cap alone, but multi-cap PMSs which are more than 2,000 crores in AUM. You'll see most have underperformed during this time, because particularly over the last 2 years, and more particularly during 22, the index was a very strong performer, and most PMSs underperformed last year, as can be seen on this slide. What this slide shows is performance of these 10 peers and ourselves over each of the years, starting from the 2007 inception. So in 2017, as an example, we were the second best strategy. In 2018, which was a very challenging year for most portfolios, because mid caps got decimated that year. 2018 and 19 were two back-to-back, the worst and second worst year for mid and small caps. And since most PMSs have, like us, a lot more mid and small cap, they were heavily clobbered. Also, 2018 in particular was the worst year for poorly governed companies. That was the year when there were a lot of governance-related disasters. So be it names like PC Jewelers, Manpasan Beverages, 8K Miles, Shankara Bilcon, Vakrangi. Most of these names were down 90% or more. The environment was quite contrary to what it was in 2017, and quite contrary to the environment today, where at the risk of generalization, a lot of companies that are companies that are poor in governance, relatively poor in governance, while there's no objective measure of governance, but a lot of companies which did very poorly in 2018 are doing very well this year, and are the companies which did very well in 2017 as well. Yeah, but 2018, we were the best amongst this peer group. In 2019, we were 4th out of 11. This diamond represents what the benchmark was. The benchmark was somewhere in between here. So you can see the benchmark did very well in 2018. 2020, we were again second best. And many of the managers outperformed the benchmark. 2021, we were 5th from the top, and similarly in 2022. And year to date, we are at an average level 5th out of, or 6th out of 11 managers. Benchmark is doing somewhat worse, so we are somewhat above the benchmark. Yeah, but in peer group, actually 22 was better year for us in terms of relative ranking to the peers, because most managers, you can see the benchmark itself was almost at the top, and most of the peer group did very poorly. And since inception, as I was saying, we've done well. Also, we are the only fund which has been, our team is the only team which has been average or above average or any of the calendar years, because right now the year is only 6 months into the year, and hopefully the team would gain on the rankings. But if you see from 2017 to 2022, we are the only strategy which is above average. Otherwise, all the other managers have been either some year at the top, other years at the bottom. Yeah, some year below average, some year above average, and so on and so forth. WhiteOak, as you can see, is the only one that has been above average, and over the 5-year period in the best performing strategy. We've also included peer group performance from a 3-year, 5-year, trailing 1 year, 3-year, 5-year, and since inception basis rather than calendar year. Here also, if you see, the performance on a 1-year basis is above average at this time. 3-year basis is also just merely above average, but above average. And on a 5-year and since inception basis, at the top of the comparable peer group. This is just presented in a different format, above and below how peers have performed. So you can see 5-year and since inception is at the top, and here just above average. Now, so obviously last 1 year and 3 years is not been as strong for us as the prior years were. And we've discussed in the prior meetings some of the reasons. We want to just recap in brief, not to be repetitive, but when any combination of the following plays out forcefully in the market, we would tend to have a headwind in our performance. When poor governance segments of the market in aggregate outperform the good governance segments. I know governance is subjective, but I think we've again discussed in the past, a lot of these sectors can be and generally agreed that these tend to have weaker governance than other sectors, and we tend to have a lot less allocation to these sectors. We have a lot less allocation to government-owned companies. And when SMID caps underperform the market, that is also a headwind for us. So what we've done is, in the prior such calls, as you would remember, we've had a number of slides that we go over to explain this phenomenon. We've tried and compressed a lot of that information in this one slide. So it's made it busier. But if I can request everyone to stop multitasking, those who are, and focus for next 3 to 5 minutes on this slide, it would be a good recap of what we've discussed in the prior discussion. So what this slide is, first of all, the timeline is from March 28, as you can see here. That is when there is performance available on Bloomberg over the last, nearly more than 15 years now, of the funds that either I have managed at my prior firm or your WhiteOak team. Yeah. Now, this blue line, which you can see over here on the screen, this blue line is relative performance of SMID caps versus large caps, starting from an index level of 100. So it means if the line is sloping upwards, like it is here, SMID caps are outperforming large caps. If the line is sloping downwards, like over here, that means SMID caps are performing worse than large cap. As I was pointing out, 2018-19, which is starting from here, pretty much at the start of 18 till pretty much till early till the COVID bottom, SMID caps were underperforming large caps. So when this goes up, it's a tailwind for us. When it goes down, it's a headwind for us. Now, if you look at this brown line now, this brown line is the performance of the market, call it BSE 500, which is say the average, versus the performance of SOEs, which is PSUs, another name for PSUs, state-owned enterprises, utilities, commodities, and so on. Yeah, so there are two factor risks, if you all remember, in our portfolio. I hope I don't need to go over the whole thing, but I'll just quickly remind these two factor risks are there in the portfolio because so from a portfolio construction perspective, the aim is to maximize alpha, minimize the volatility of alpha. And alpha comes from stock selection, so our focus is on stock selection. In mid and small cap, there is a lot more alpha potential, so we allocate about 20% or thereabouts more in mid and small cap, and hence when mid caps does poorly, it's a headwind for us. But despite that, in 2018, we were the top performing manager. The reason was this next slide, because we also, for similar reasons as the prior slide, we allocate more capital to what we consider better governed segments of the market rather than poorly governed segments of the market. So in 2018, because poor governance did extremely poorly in the market performance and well-governed sectors did well, this factor being more powerful in our portfolio, overcame the mid-cap factor to generate top-notch alpha. Yeah, so I'll come back to the slides if necessary, but this is a slide we've covered at length last time or previous times, so don't want to spend too much time on that slide. So when this brown line is going up, that means the market is doing better than this poorly governed sectors. And when poorly governed sectors are doing well, then this line would be going down, like in 2022. So basically, when the design is such that when these two lines are both going up, or whenever either one of them is going up, that represents a tailwind. When one is going down, that represents a headwind. On this graph now, you see three colors. What pinkish color, pinkish red, green, and the beige one or the gray one, depending on your color settings. Now, the red zones like 22. So at the top of the graph, you see the time period. So this red zone lasted from December 21 to December 22. The red zones represent those time periods when both these factors are downward sloping, meaning they are both headwinds to us. Okay. The green zones are both tailwinds to us, like, you know, when from 2009 to 2011 or so, or end of 2010 or so. And the gray zone here, which is most of the graph, is no headwind, no tailwind. In a way, think of it as, you know, green is a home ground advantage to us. Red is a ground where particularly difficult for the team to perform, if you were to use cricketing analogy. And gray is more neutral ground. Yeah. Now, in the red zones, there have been 8 red zones in the past, as you can see here, and so on. So there are 8 of these. It was interesting for us to see that each of the 8 times we underperformed by -5, -5, -5, -5, -4, -5, -7, and -11. So each time we've underperformed, this one was the worst, because if you notice, this was the longest lasting. This one lasted for 12 months. All the others have lasted for 3 to 6 months. The green zone, each of the green zones, which is a home ground advantage, if you will, we've outperformed. +16, +6, +9, +5, +6. Now, this is where you are an advantage or where you are at a disadvantage from these dual headwinds or tailwinds. Important to, hence, most important, I would to see how we did when there were neither headwinds nor tailwinds. So you'll see each of these times when there's neither any headwind nor any tailwind, the team has outperformed 5%, 15%, 2%, 36, 6, 5, 15, 18, 8, and now approximately 2%. So when there is no headwind, tailwind, or when there is tailwind, 100% of the time, so far, historically, the strategy has outperformed. When both these are headwinds, the strategy has underperformed each of those times, but then has obviously bounced back, as these are time periods that are not permanent in nature. You don't just play on one ground all the time. The grounds, as the cricket team plays, the grounds keep changing. Some grounds are suitable, some grounds are not suitable for any team. Now, this is the length of time that this phenomenon existed. What this slide shows is the magnitude of these factors at risk. So this is again a slide that you might be familiar. The green and the red over in this graph represent the alpha of the strategy over time. You'll notice that for most part, it is very solid green, and the worst here is this. Now, what you see in the next row is the performance of benchmark versus the underweight segments of the market, which is the poorly governed segments of the market. And then next is the mid cap versus large caps. Yeah. So here you'll see there have been different times at which these two have been negative. But if you were to simply add these two, it is logically or analytically incorrect to simply add, because one factor can be more powerful than the other. They're not equivalent. Governance is a more powerful factor. But for simplicity, if we were to simply add, this minus 29 has been the most severe time period. Yeah, the prior weak time periods were 2019, 2016, and so on. And you'll notice that sometimes we've been able to, like 2019, overcome this magnitude of headwind. Sometimes we've not been able to overcome. This time it being so severe and stretching out as long as we saw over here, this was like 2 or 3 red events occurring right after one after another without any break in between. And hence the alpha hit of minus 11 compared to what typically was minus 5, minus 6%. Now I would also highlight again that over this is graph we've gone over before. This has been, so what is represented in this graph is just represented in the next graph that I'm going to share in a different format from a different starting point, maybe somewhere around here, where since the WhiteOak's journey, if you will. So since our start in August 2017, for the first 3-4 years, that was a tailwind to us, the relative performance of overweight versus underweight sectors. So poorly governed segments of the market were doing poorly. On average, that's why the index went from 100 to 125 over here. Yeah. So upward sloping is a tailwind. And our alpha, you will see, was very strong, super strong during this time. Yeah. And then over the last 3+ years, since the COVID bottom, there has been a pretty much a unidirectional outperformance by poorly governed segments of the market compared to the better governed segments of the market. Now in mid cap, it's a little, so, and over this full time frame from start till year, you'll see that the poorly governed segments of the market have underperformed the better governed segments of the market by 25%. So net, it has been a headwind to us over this 5-year period. Particularly over the last 3 years, you'll notice that it is far more severe. I'm just undoing it. Over the last 3 years, it has been very severe from a 125 odd level to 75 odd level. So a 40% hit from top to bottom, 40% of 125. In mid caps also, you'll see that from starting point to end point, it has been a about 20+% headwind to us. Though in the initial 3 years, this was a headwind for us, but at the time, the governance was a good tailwind for us, and governance is a stronger factor in the portfolio. And hence, despite this headwind of mid cap doing poorly, we generated very strong alpha, as I was showing here. And in 21, this mid cap was a tailwind for us, which offset a lot of this decline or headwind in the governance front. But in 22, even mid cap as well as the poor governance, both were headwinds to us. So there are these factor risks which are very crucial and important to understand. While they may not be so obvious at first, based on just the numbers that investors would typically see. Now, oftentimes, investors ask us, what is an appropriate time period to measure your performance? Globally, sovereigns and all those do ask. And my typical answer is not a defined time period. Some say 3 years, some say 5 years, some say other figure. I've always said it is appropriate to measure us from like point to like point in the cycle, okay? With some adequate time period in between of more than a couple of years. So like point to like point in the cycle means what? And like point with respect to what? It is like point with respect to the factor risks that the portfolio is exposed to. Now, we don't do any market timing. So market beta is not a factor risk that we are exposed to. But this is a factor risk that we are exposed to. Now, some people who do market timing or who have a beta of 0.5 or a beta of 1.5, for them, beta would become the appropriate risk factor on which you have to measure like point to like point. Now, if you just measure our performance relative to peer group over the last 3 years, you will find that we've done an average job, as we shared in the prior slide. There's nothing remarkable about our performance. And you would all tend to really like managers who are, because just as we have this strong tilt or bias towards better governed companies, there are many managers out there who have a very strong tilt towards poorly governed companies or somewhat weaker governed companies on the whole in the portfolio. Like, take government-owned companies, for example. We hardly own government-owned companies other than for risk mitigation purposes sometimes, yeah. But many managers have a lot, probably the biggest allocation in the portfolio in government-owned companies. And they either have it throughout time structurally because they like the low PE multiple that these guys trade at or the dividend yield that these guys provide at. So if you compare our performance to someone, and there are a lot of those out there that we don't need to name, but there are out there who have such names, not just government-owned companies, but other companies from the sectors that segments of the market that we discussed, then over the last 3 years, they would do fantastically well. Yeah. Now, if I go back to this, if you see let's see 3 years performance. So 3 years, portfolio 9's done very well. Portfolio 7's done very well. Portfolio 6 has done, portfolio 4, sorry, I missed out. The portfolio 4 has done on a 3-year basis fairly well. So look at portfolio 4, okay? Now this is a good example here. Now on portfolio 4, if we go back to, so if you look at portfolio 4, in year like 2018 was the worst performing portfolio. In year like 2019 was worst performing portfolio. Yeah. And in 21 was best performing. Now, quite possibly, I don't know off the top of my head, and I anyways won't share with you who is portfolio 4. But portfolio 4 probably tends to own companies where, maybe government owned or otherwise, what the kind of sectors or segments that we talked about. And similarly, portfolio 9 possibly has some, or portfolio 10 possibly has similar traits. So in years like 2018, where we were best, these guys were at the bottom. And in year like 2022, some of these guys are, would be at the high end. Well, some of them are at low end on both the times. But I hope you get what I'm trying to say. If you were to look at this performance in the reverse direction, meaning this is the first year, this is the second year, this is the third year, fourth year, fifth year, sixth year, and so on, then our last 2 years would be fantastic, because these 2 years would show as top performing. But if you understand that these are representing these different time periods in the cycle, and hence this time period is not necessarily an upward, even though it looks like a 3-year time period, it's not a like point to like point on the cycle for our strategy, because this is a major factor exposure in the portfolio. And if you were to look at someone else who has the reverse factor risk, meaning a lot of poorly governed companies, they would have done extremely well over this 3-year period, but their prior 2 years would have been possibly very, very weak. Yeah. And if such a time period comes back again, when poorly governed companies do poorly and better governed companies do better, then that would become a tailwind to us and a headwind to these folks possibly. So how long is a good time period to measure? That is not as simple as anyone would expect, 1 year, 3 year, 5 year, any such number, but it is a function of what factor risks there are in the portfolio, and what kind of current market environment is, and when was it last similar market environment. And hence, if you see, it would be okay to measure us from this point to this point. Yeah, if it would be okay to measure us from this point to this point, yeah, or from this point to this point, or to this point. These are all crossing at 100. So on the governance factor, these are like point to like point in the cycle. But in fact, it would not also, I mean, we've had some headwind from year to year as well. Despite the headwind, the performance is top notch. Yeah. But this is somewhat of a non-like to like comparison time period, even though it may be longer time period than from year to year. The reality of investing is it's very complicated. So beyond a point, or let me put it this way, the reality of performance analytics is it is very complicated. And that is why if you just simply go by who's the best performing over the last 12 months, 24 months, 33, 36 months, it does not necessarily play out in forward-looking manner. The best performing managers from 2013 to 2017. So when Modi ji was nominated for by BJP party mid 2013 to December 2017, the best performing managers during those time ended up being most of them ended up being the worst performing during 2018 and 19, and the best performing during 2018 and 19 were possibly lagging the prior years or are facing challenges in 20 year like 22 for the governance factor, which is one of the important dominant factors in most portfolios, yeah, including ours. This just shows our performance compared to international peer group as well, global peer group. Yeah. So just wanted to share that it is not any different over there. We had a blue means we outperformed the peer group, and the darker the shade of blue, higher was our performance. So in 22 in global peer group, in 20 in global peer group, we were the best performing. In 2019, 21 as well, we were very strong performing. 22, we were below the benchmark, underperformed the average as well, who weren't the worst because there were others who underperformed as well. But relative to the global peer group, we were below average. As you saw, domestic peer group, we were slightly better than average, but global peer group, we were below average. And Since inception, though, we are very much at the very top, the second best manager being 14% below us compared to 93, 79.6 in the cumulative sense. And the benchmark is here, but the ETF is here because remember, benchmark doesn't pay taxes, and these fund performances over here are after paying taxes because these are funds, not PMS account. We continue to, even this year, we won the Lipper Funds Award globally, as these awards are based on 3-year and longer time periods. In 22, we cleaned out all the awards because they included the prior years, very strong years. Now, what changes have we done in the portfolio over the last couple of years to further mitigate the risk? It's not that we are completely out of the large cap, for example. We do own large cap because otherwise it will be too risky a portfolio. And similarly, the red zone that I showed from a governance perspective, we aren't completely out. Though at the end of 21, we were, from a risk management perspective, somewhat at the outer edge and were more or less completely out. Since then, to mitigate risk, we have added to selectively a few names. So you'll see a couple of changes at a sectoral level. In December 21, information technology services were 8% overweight. Currently, it is more or less flattish, which is also represented here. And in case of industrials, a lot of new additions have been made, and the weight from -1% is now 5.5% overweight. Industrials mitigates the risk. Historically, also, that's been our experience, that when these segments like utilities, commodities, be it metals, energy, and all, and the government-owned companies, when they do well, when the operating performance is strong, they end up doing a lot of capital spending, capital expenditures, which then benefits in turn the industrials. So these industrials do act as a partial hedge, and that is what we've included in the portfolio over the last 12 months or so, which seems to so far have worked well in mitigating that risk. As you can see, the series of names, these are all the industrial names only that we've highlighted here. They have relatively, for most part, outperformed and helped performance over the last 12 months. This is just the performance of some of the participants are invested in our global emerging markets fund as well, and emerging markets ex India. But since there are fewer of those than India strategy, we won't spend too much time detailing these, but the team is off to a very good start in the EM fund. We've completed 12 months on June 23, having started it last year around this time. So the teams delivered in dollar terms 11.6% return compared to EM benchmark of -1 for 12.5% alpha. And in INR terms, 16% return compared to 3 of the MSCI EM benchmark for 13% alpha. Just because the dollar has depreciated, there's a little bit extra. This performance of EMX India, as several investors had concerns about whether in their LRS they can invest in EM, which also includes India. So based on that feedback, 6 months after launching our GEM, we also launched the and some of the distribution partners also had expressed that concern that their clients might not be able to invest in a GEM fund through LRS because India is part of GEM. So we are probably the only ones who have a GEM X India portfolio, which we launched towards the end of last year. And since, year to date, if you see, the portfolio has done very well, delivered 10.6% return compared to 4.85 as of end of June for a 576 basis points of alpha. This is in US dollar terms, and this is year to date return in INR terms. Obviously, this year to date, BSE 500 is somewhat lagged emerging markets peer as of end of June. This is just the portfolio composition similar to India. Energy and utilities, we don't have any exposure there, have more in small cap and mid cap combined. Again, I'll skip these slides unless there are questions on EM. This is representative portfolio of EM. So some of the names you'll find very familiar. Hermes and LVMH are the leading fashion giants, including Richemont, which owns the brands like Cartier and Van Cleef. But I'm going to skip these for now. The valuation, obviously, for EM is at on some measures at historical low levels or below long-term averages. Going to keep moving. So this is an interesting chart. Over long term, most markets end up giving similar returns. Yeah, as you can see from 20 to 22, while in the first decade, India did extremely well and global did very poorly. US was the worst performing market in the first decade of this century. The next 10 years, US was the best performing market, and India, in fact, was the worst performing of these major compared to these multi-regional funds during the last decade, 2010 to 20. But when you combine these two time periods, you have more or less similar range of 3 to 6%. Europe is the laggard, whereas S&P US 5%, EM 5%, India 6%. Now 2020 to 23, India is leading, and that's why obviously everyone is bullish on India, including us all today on the call. My observation is people are most bullish and sentiment is most positive for markets which have recently done the best, as was the case in 2010. Everyone was bullish on EM and India, and whereas at the end of 2020, that wasn't the case necessarily. The FANG and the US and the NASDAQ was most popular at the end of 2020, including, I think all of us can here on the call relate to that sentiment. Over this time, earnings disparity has not been much over the last 3 years, but performance, India has been best performing and EM has been the worst performing. So these all slides we've discussed in the past, so I'm going to keep running forward and see if there's anything else I want to highlight here. I want to highlight one other on the long, yeah. So this one, again, to the question of what is long term. Just 3 months ago, there were a lot of client questions and client comments like, over the last 2 years, the market's gone nowhere, or 18 or 20 months or something. I would have made more money in fixed income than I've made in equity markets. Yeah. And several people also switched to fixed income because fixed income was providing very attractive returns, and there was a tax law changes that allowed before March 31st, if you invest in fixed income, the tax law or some like insurance products or something or the other was more attractive. And unfortunately, there's a lot of switch into from equities to there. Now, over the long term, we've seen this fixed income is a guaranteed real loss, whereas equities are uncertain but compounding gains. And I'm sure many of you have, I've discussed this slide with many of you, but this is from 1985, the year when I got sucked into as a retail investor into equity market. So I can relate to this time period. 1985 to today, fixed deposit of SBI has made 1 crore starting then is equal to 9 crore today. Inflation itself is 14, would be 14 crore. So in real terms, a person has become poorer in fixed deposit. So fixed deposit, everyone believes, is a guaranteed return. You can sleep well at night. Actually, it's not a guaranteed, it's a guaranteed return in only nominal terms. In real terms, it's a guaranteed loss of a small magnitude, not just in India, but everywhere in the world, this phenomenon holds true. Gold has gone from 1 crore to 27 crores, and the Sensex has gone from 1 crore to 176 crores at compounding at 15%. So this right-hand side chart is the same chart as the left-hand side, but this line is if someone is outperformed by 10%. Now, over the last 38 years, it was a lot easier to outperform. It was extremely difficult, but certainly easier than it is today to outperform by 10 percentage points, because markets do become more and more efficient if not every year, every decade. It's an evolutionary way. But there are several who have generated over this time 25% return, and for them, 1 crore would have gone to 4,264% return. 264 crores. So huge difference between 9 crores or 176 to 9 crore to 176 crores to 4,264 crores. Now let's just focus for a minute on the market and fixed income. Yeah, it would appear from here, this graph, that on every time horizon, the market is ahead of the fixed deposit, because this line is always ahead of this line. But that hides, the reality. Unfortunately, reality is lot. The details are, lot more uncertain or lot more volatile. So this graph, we have basically broken this this graph, or at least this market line and the fixed deposit line, from rather than showing them in one graph spanning 38 years, we've broken it down into different time periods, starting with the first 1 year, starting with December 24. The markets had a strong rally. 1985 still remains the best year on record, giving 100% return. Yeah. And then, someone who's invested in December 84 certainly has always experienced a stronger return than the fixed income return, even after a 50% fall in 93 post Harshad Mehta. Yeah. But at the peak of Harshad Mehta, if someone would have invested or had from year to year, the money went up 16 times from end of 84 to peak of Harshad Mehta scam. Now, most people get sucked into the market right around the top, as we all know, and as evidence suggests. If someone had started at the peak, obviously, of March 92 or something, even until 2009, that person would have been underperforming in the equity market compared to fixed deposit. Still, we all agree equities over time is a superior asset class. Long-term equities provide superior returns compared to fixed income. But there is this big uncertainty factor about starting point and ending point of measurement. So it's not 1 year, 2 year, 5 years. So people 3 months ago were somewhat frustrated that over 2 years, their fixed income was delivering higher return than equity portfolios. But there was a time from a certain investment point in time till 2009 that the fixed income over a 17-year period would have beaten returns from equity markets. And if you see, during from March 92 to March 2003, 11-year time period, the difference was huge. Basically, equities were flat from 92 to 2004. Yeah. Whereas fixed income would have more than doubled, because in the 90s, the interest rates were very robust. So this first time period is from 84 to 93, the peak of just past the peak of 92. The second time period is from the peak point in 92 to the bottom of the next bull run in March 09. And then this third graph that we've drawn here is the time period where we have a performance track record, which starts from March 7. So somewhere around this time frame is this point. And from here, you'll see that fixed deposit would have given 115% return. Market has gone up 6 times, so 517% return. And the strategy has gone up 16 times because of the strong alpha generation over this time. However, just like the market has not returned in a straight line fashion, and you can see there are different periods, like from year to year, over a 3-year time period, the market has underperformed fixed income. Similarly, from this high in 2007, which is equivalent to this high, to somewhere over here in 2013, before the Modi bull run started, from January 2008 to 2013, for a 5-year period, or a little longer, because this is just straight line, whereas fixed income would be upward sloping. For more than 5 years, fixed income did better than equities. Yet we all agree, possibly even then equities are the best, certainly compared to fixed income over long periods of time. Similarly, the alpha, if you think of our portfolio performance as equivalent to the equity market, and the benchmark performance is equivalent to the fixed income, it is highly unlikely to be the case that we will always outperform over every given time period. And that has not been the case in the past as well. For example, over here, we were here, whereas we at some point here, we were lower. So over a 2-year time period, we did underperform, 2 or 3 year time period. Even here from, if we measure from the peak over here, we regained that point of alpha somewhere over here. So from March 08 to somewhere in 12, point to point, we might not have underperformed. However, if you combine over the long time period, the alpha generation has been 1,000 percentage points during this time, money becoming 16-fold compared to 6-fold. Yeah. An important caveat I want to point out, these are gross of fees, as is the market benchmark and the FD, because the fees vary from fund to fund, from investor, from share class to share class. So I just caveat that you can deduct 1 to 2% of the fee from this, depending on the share class on an annualized basis. So with this, there are a lot of other things about the macro, but I leave that for most part for Q&A. But now switching quickly to the Indian macro, the earnings growth has accelerated over the last 3 years. While FY21 was supposed to be a disaster year, actually it turned out to be very good. And we've had a 20% CAGR over the last 3 years compared to 5% for the prior 12 years. As the profit cycle has turned from 08 till 20, it was on a decline, bottomed out around 1.5, and now has come back up to long-term average of about 3.5%. As you can see here, FY21, 22, 23, and now projections are for about mid-teens growth. The valuation, if you see presently at about 20 times, is more or less in line with the Modi era valuation of about 21 times. When viewed from a very long time period, over a 30-year time period, the average is 17. So we are about 10 to 15% higher than the very long period average, but in line with, so call it valuation is within the reasonable zone, be it from price to book or P multiple. From on EM perspective, we are at a 2 sigma or more of a premium because EM multiple has come down due to China's derating. So I've gone up mid cap and small cap. So this is for mid cap. Mid cap premium has gone up over the last a couple of years. So something to bear in mind, and small cap as well with the big surge over the last 3-4 months. So I'll stop here.
Thanks, Prashant. Today I'm going to speak about CRDMO, which basically stands for Contract Research, Development and Manufacturing Outsourcing, which we do believe is a scalable growth opportunities from the Indian pharma perspective. So just to talk about first on the Indian healthcare, while it's a large market, if you look at India healthcare today stands for around $145 billion and probably one of the fastest growing segments among many segments in the country. Yet when you look at in terms of whether we talk about healthcare infrastructures or even the penetration of modern medicines, still I would say this industry is hugely underpenetrated compared to the standards which have been set by WHO in the emerging markets. Again, if you look at from a segment perspective, healthcare can be split into 2 sub-segments. We call it services, which is around $85 billion industry. Overall, India healthcare is growing between 10 to 12%. Services, which largely consist of hospitals, the largest segment of market, around $72 billion. Diagnostics, around $11 billion. And when you talk about manufacturing, which is around $60 billion kind of market as we speak. And within manufacturing, you see pharmaceutical manufacturing, which consists of both formulations and API, intermediates, etc., is around $50 billion. and medical devices is around $10 billion. Now, between manufacturing and services, there's an intersection of something called CRO, or contract research outsourcing, or CDMO, which is contract drug development and manufacturing outsourcing, which together, as we speak, works around $5 to $6 billion when we think about in terms of the total addressable market for Indian pharma companies. Now, if you look at Indian pharma, which today is known as pharmacy of the world, while already when we think about the vaccines, probably we are the leader, given that every second vaccines which is being consumed in the world are being manufactured by Indian companies. COVID-19 was a testament to our manufacturing capabilities as we stepped up during a time of crisis. Now, while we're talking about today on the CRDMO, in our view, the relevance of India in the global outsourcing trend would improve over the coming years, since given the service DNA advantage what we have, access to a large talent and treatment-named patient pool. We have already seen that in the IT industry, where India today has established global dominance and continue to gain market share, and we think CRDMO would be the next big growth opportunity for the Indian companies. A little busy slide, but what I'm trying to focus here is who these CXOs are and what really they do. So historically, the drug discovery is a pretty long process, and which consists of multiple steps, right from preclinical to clinical development and finally commercializations. And in the past, there used to be a specialized service providers for each of those service segments. But as we've been seeing the recent trends, where countries or companies are emerging more like as an integrated players, and they would like to provide end-to-end services under one roof. And probably we'll talk a little more in details as we move forward. Again, this slide basically focuses in terms of the addressable market opportunities for CRO, CDMOs, or so-called CRDMO. If you look at overall, the size of the pie is around $155 billion, while the global pharmaceutical industries are likely to grow early single digit to mid single digit kind of range. But when you look at the next 8 years, forecast for the CXO industries are around 11.5%. So this industry is likely to grow almost 2 times than what the global pharmaceutical industry is likely to be. As I indicated earlier, India CDO or CXO stands today at around $5 to $6 billion. When we look at this CXO, again, largely we can split that into 2 segments: CROs, which is contract research outsourcing, and CDMO, which is largely development and manufacturing. And you can see the CRO is around $79 billion and CDMO is around $76 billion. Now, within CDMO, and which is likely to grow faster at 13%, you have the small molecules, or the molecule which can be synthesized in the laboratories, and we'll speak a little more in terms of the difference between small molecule and the large molecules. But clearly, if you look at the point what I want to drive here, that biologics, which are the large and more complicated molecules, are likely to grow at a faster clip of 15 to 17%, and which is almost like 2.5, 3x to the overall pharmaceutical industry growth. This slide basically talks about the difference between small molecule and biologics. Well, small molecules are the molecules which can be synthesized or produced in the lab, while the biologics are made up of living cells like RNA, mRNAs, and DNAs, which are the living cells, and obviously they are very complicated and large protein chains. Just to put it in the layman language, like manufacturing a bicycle is equivalent to a small molecule drug, or like aspirin, then biologics or monoclonal antibody stands like you're manufacturing a private jet. So that talks about the kind of complexity what the large molecules or biologics stands for. Again, a little bit busy slides, basically talking about the whole drug development process, where if you look at in terms of the probability of success, that if a company starts with screening of more than 10,000 compounds at early drug discovery stage, only one drug is being commercialized or approved. And that's the kind of probability in terms of success. When you think about the time it takes in terms of developing that molecule, it's anywhere between 12 to 14 years. And once the molecule gets commercialized, the patent life or the finite life of the drug, where the drug developer or the innovators has to recoup the entire cost of development within that 8 to 10 years period. And hence, I think the turnaround time becomes very, very critical. And third is, if you look at over the last 40 years or 4 decades, because there are higher rate of failures, the drug development cost has gone up from $180 million in 1970s to $2.5 billion. And in order to de-risk their R&D, increase speed to market and faster turnaround time, and to reduce the cost, large and emerging biotech companies are now moving to more and more outsourcing kind of business models. Now, a couple of drivers which we would like to focus in terms of why the CDMO or CXOs are gaining or becoming much more relevant for the market. As we've been talking about biologics over the last few slides, today, if you look at biologics are gaining share, though small molecules are still relevant. 30% of the sales today in the global pharma market comes from the biologic drugs. But when you look at in terms of the incremental pipeline, which is in development, almost 45% of the drugs are coming from the biologics. And you can see the R&D spend on the top right-hand side, that the R&D spend on the biologics is going at much faster clip versus the total pipeline R&D spend. And if you look at in 2020 itself, 50% of the drugs which are being approved by the regulators in the US are from biologics. So obviously biologics are clearly getting the tractions. And given these biologic drugs are more complex structure, they require longer research timeline, and hence probably you need, I would say, dedicated and capable CXO or CDMO players who can obviously capture these growing opportunities in the CDMO space. The other key drivers for the growth is, again, the increasing importance of small and virtual biotech pharma companies. If you look at in 2021, almost, I would say, maybe 44 to 45% of the investment in the R&D has come from the companies which have virtually no infrastructures in terms of manufacturing or large R&Ds. They are probably being started by the scientists either in the universities or maybe a group of small people coming out and starting their development work from the small labs. And these are the people who are gaining much more importance. And by 2030, you will see more than 50-55% of the spend will be done by these small biotech pharma companies, which you can see that while the R&D spend on the top right-hand side by the large pharma company are likely to grow by 4.5%, but the small and virtual pharma company will have almost 11% kind of CAGR R&D spend. And these are the companies, again, they require the services of these CXOs, CDMOs, and CROs in terms of obviously doing the clinical trials and then getting into the commercialization of the molecule. And most of these small biotech companies largely have a focus in terms of asset-light model, and hence they are largely reliant on outsourcing. Another critical point I would like to highlight in terms of, again, the growing trends of drugs, which probably are being meant for the rare diseases. Now, you may have very limited number of patients for these drugs, but given that these drugs have got faster acceleration in terms of regulatory approvals, and there's a lower development cost, the share of orphan drugs in the overall pharma industry has gone up from 4% in 2000 to now 15% in 2022. Now, these are the molecules which are very novel in nature. Probably they require small volumes, but the value component is very, very high, that as these drugs comes with a very expensive price. But given that they are meant for the rare disease, there's a higher propensity of failure and or lower probability of success. And even the batch size are also relatively smaller. And it doesn't make sense for the pharma companies to put dedicated infrastructure for these kind of modalities, and hence increase outsourcing requirement. Now, this slide basically talks about that how the CXO helps in terms of bringing down the cost of development as well as faster turnaround and hence shorter clinical time. If you look at whether in preclinical or clinical, CXO companies in China or US offers maybe 30 to 60% lower cost versus the drugs which are being developed in the US or Europe. And they also shorten clinical time by 24 to 42%. Given that they have availability of large patient pool available, and you take it like this way, that if a drug has a finite life of around 9 to 10 years, and if a blockbuster drug, contribute around $1 billion kind of revenue in a year, and if you cut short the development time by 6 months, it leads to $500 million incremental revenue to the innovator. So innovator won't mind maybe spending, money in order to cut the, development time or faster turnaround time, and hence they, apart from their own resources, particularly of the large pharma company, even they also go for some of those, CXOs in order to develop or have more molecules in the pipeline. Now, if you look at in the bottom left, there's clearly an increased outsourcing trend. However, given that the innovators are very, critical in terms of the IP protection, still, I would say the outsourcing in China or India is between 15 to 20%, and the majority of the outsourcing is still happening in the US or Europe. As we see this innovator gaining more confidence on the Indian companies with regard to IP protection, which we already started seeing that kind of trends, or some of the companies, in China who are global partners, we believe that probably the pie of this outsourcing towards Indian emerging market is likely to increase further. As you all know, and since Prashant spoke about this, that we do have a global emerging market fund. And as a part of that, we have this company, WuXi Biologics, which is the third largest, CDMO company in the world. And it's a very interesting case study. Like WuXi Biologics, maybe around 15 years ago, they started as a CRO player, and where they start offering the discovery services, particularly to small and emerging biotech pharma companies. But over time, they have successfully moved up the value chain, and today has become a fully integrated, CRO stroke CDMO players. And if you look at, as they have kept moving up the value chain, even their engagement with the customers, where in discovery services, probably the average revenue per molecule used to be $1.5 to $2.5 million, has now, for the commercial stage molecule, the average revenue per molecule has gone to $50 to $100 million. And that's what it has led to 50% kind of compounded 5-year CAGR growth for the company from 2016 to 2022. And even despite such a higher base, company is very, very confident that they are likely to grow for another 35% CAGR over the next 4 to 5 years. Today, when you look at in terms of their client mix, 60% of the revenues comes from these small and emerging biotech pharma companies, with whom they started as a CRO player, and over time they have started supplying the manufacturing services, while the 40% of their clientele comes through large pharma companies. Now, why we believe that India has all the right ingredients in place, and probably as I was highlighting earlier, that we do see that CRDMO on the biologic side probably is going to be a significant growth opportunity for the Indian companies in times to come. Because when you look at in terms of talent, probably India produced the largest pool of engineering across the globe. And when it comes to in terms of the labor cost per hour, probably India being the cheapest. And not only this, I think there are two other inherent advantages what India offer is availability of large, diversified and treatment need patient. And versus China, probably the ease of communication with the Western world. So we do believe that India has right ingredients in place, and probably the way like some of the Indian companies have moved up the value chain and today have become global competitive. Whether you talk about fluorinations or you talk about small molecule, I think the biologics would be another area to look forward. Again, just putting things into from a WhiteOak perspective, when we think about any investment, obviously we look at the two critical components or attributes, in terms of wherever the mix of these two facts are there, like in terms of great business and attractive valuations, those are the businesses which we would like to own. And when we talk about great businesses, there are three attributes which we look at. I'm not going to spend too much time out here, but maybe just to probably sum it up very quickly. One is the superior return on incremental capital, scalable long-term opportunity, and execution and governance DNA. And when you have all these three attributes in a company, it is very crucial to value it in a logical and robust manner, and buy it at a price which leaves substantial upside to the fair value. Just to highlight that when we talk about valuations, we don't focus on the traditional valuation multiple of P or EV or beta. However, instead of looking at those multiple, what we focus is on our proprietary analytical framework, what we call OPCO-FINCO framework. Now, just to conclude, our sector investment framework is built on 4 key attributes, which help us to identify companies having superior return on incremental capital, scalable and sustainable growth opportunity, and create value for stakeholders. So any company, when we evaluate the companies, what we look for in terms of the mix of clientele, whether the company has a good mix of, emerging biotech pharma companies and the large biotech pharma company. And we would like to invest in the companies which works for the innovators versus for the generics, because the sustainability of the cash flow and the longevity of the cash flow is far higher when you're working with the innovator molecules, because there is a 15 to 20 year kind of duration for that molecule in terms of longevity. The second critical aspect which we look at in terms of, again, evaluating the companies in the CDMO space, again, the compliance, because manufacturing compliance, regulatory compliance are very, very critical. And your customer want you to have all those very good compliance track record and respect to their intellectual property, which I was highlighting. The third, what we have called is PUSI way. That means the integrated business model, where the company have a successful track record to provide services successfully both in CRO and CDMO, and hence, obviously, they offer the services as a one-stop solution. And last but not the least, that companies should able to address all the new modalities which are becoming critical, like ADS, or oligonucleotides, peptides, or cell and gene therapy. So these are some of the key things which we look at. Just to put it together, we do believe that the relevance of India in the global outsourcing trend would improve, and early signs are clearly visible.
So we have a few questions on the chat box. Maybe Prashant, I'll ask you the first question. There are a couple of them along similar lines. Essentially, from an investor's perspective, if they had to invest or choose between investing in the WhiteOak FlexiCare Mutual Fund or the Pioneers PMS, what should they choose, and how is their positioning different? If you can please help clarify.
I think we get the question on every session, as obviously new participants join the call, which is very great to see. So as I have outlined earlier in the calls as well, we expect both the Flexi Fund as well as the Pioneers to do well. Now, there is a difference that the Flexi Pioneers is, or the Pioneer equity is more HNI strategy, meaning it is offered to PMS, AIF, kind of 50 lakhs and plus. Whereas in the MF, everyone can invest, even smaller investors. Generally speaking, MFs have to be a little bit more risk aware or risk uh, mitigation tools they have to deploy. So they do tend to be somewhat closer to the benchmark, not just at WhiteOak, I would say across board compared to the PMS. Now, in years like 22, when benchmark does very well. So in a year like 22, when the benchmark does extremely well compared to most of the PMSs, right, over here. In that year, 9 out of 10 times, I have not looked at, but I can be very sure in years like this, MF in general, all mutual funds in the, not each and every, but the average mutual fund would do better than the average PMS. So you'll find a lot of PMSs doing better, a lot of MFs doing better than the PMS. And similarly, a team, same team, if it were to run an MF as well as a PMS or research team is common, you'll find the same thing. If they're doing what they're expected to do, then in a year like 22, MF would do better than a PMS. Similarly, for the average, not necessarily I'm saying for our case, because you know, there are competing factors at play, but like the governance is an important factor as well. But a lot of PMSs have a lot more mid and small caps. So in years like 2018, when mid and small caps do very poorly, you are expected, you would likely see mutual funds do better than PMS, because mutual funds would be more closer to the benchmark. So the same would be true for us. There will be certain years where the MF would do better, particularly if it's a strong year for benchmark relative to the PMSs. And vice versa, if a lot of PMSs do well, like in a year like 21, quite possibly PMS would do better than MF, or a year like 2020. So it is to summarize, the MF has greater awareness of the benchmark. As a very specific example, I believe our MF fund still continues to own Reliance Industries. They cannot be, 8% underweight or 9% underweight Reliance Industries, whereas PMS does not own Reliance Industries. So in a PMS strategy, that kind of a 8%, 9% underweight risk, even if Reliance rallies, PMS would have a headwind, but that risk is tolerable. And you'll find a lot of PMSs don't own such large cap names as Reliance or HDFC or other names. Yeah, we do own HDFC Bank, but I'm saying other funds may not own in PMS those names. But if you find in MFs, in most MFs, you will find these names at least underweight, but you will still find these names because they are more benchmark aware. And if you are closer to the benchmark, then years when benchmark does very well, you will again be closer to the benchmark and do better than most others. So I hope I've explained there's no such answer. I personally don't have a favorite between PMS or MF. Certain years one would do better, other years other would do better. If an individual's risk appetite is less for a alpha volatility, then it may be better to consider the MF. And not just for us, but for anyone. In the industry, PMS is likely to be more volatile in alpha. As you can see in this graph, whoever is this portfolio 9 was at the bottom at the top in 2017, at the bottom of 2018, somewhere in the middle, then at the top, still top, and then at the bottom on 20. So PMSs can be, we are in a way the most consistent amongst the PMS group, being, as I highlighted earlier, average or above average in each of this time period. But with MFs, you would find even more consistency, or closer, the range of outcomes would be narrower around the benchmark.
Thank you, Prashant. Just another question for you, Prashant, before I go to Manoj, is Given that the government-owned companies are showing strong profitability, do you see any structural change in them in a way that WhiteOak strategy can start allocating to them?
Yeah, so see, we may allocate from time to time from a risk mitigation perspective, but our belief remains the same that as an alpha opportunity, these are low alpha segments of the market. Let's look at this chart. So there have been several years when the government-owned entities have done well, or let's say government and poor governance, because we don't have just for the governments. Yeah. Like here in 2016, in 21 and 22 have been two back-to-back years. So this is a graph of HDFC Bank versus PSU Bank. So not the entire government sector versus the market, but just the top private sector company versus the Nifty PSU index. Now, 3 years in a row, PSU banks outperformed HDFC Bank. Yeah, this is the difference. So what we've shown here is HDFC Bank's performance compared to PSU. Cumulative HDFC has delivered 842, cumulative 33, and annualized alpha 14.5. But it hasn't come in a straight line. There was a 3-year period, 2007, 8, 9, where the government-owned banks outperform HDFC Bank and possibly most of the private sector banks. Now, one could have said, and if you go back prior time period, 03, 04, 05, you would find such, again, time periods as well. And could have, I'm sure at that time also people believed it's structural now, for whatever reason. Private sector is going to struggle or PSUs are going to have the government backing, because that was a time there was a lot of uncertainty around the global financial crisis. So the belief was that the government-owned banks have the government backing, so they would not go bankrupt. There's private sectors, who knows? Yeah. So at the end of 09, one would have been very susceptible. As I was sharing with the countries also, at the end of 010, everyone believed US was going to the dogs. But then next 10 years, US ended up being the best. And at the end of 2010, everyone was very gung-ho on emerging markets because they were going to be the new growth engines. All the developed worlds were in problem. Yeah. But the next 10 years, EM was the worst place to be. So same way, investors, not only I'm saying retail investors, but even fund managers do ask this question, and analysts do, often get swayed that now it's the new era. Remember, just 2 years ago, or in 21, everyone was talking about fintechs. BNPL was the buzzword. Forget about government-owned banks. These BNPLs in 2020, post-COVID, were supposed to kill the private banks also and take away the business. Now nobody is talking about BNPL. That word is forgotten. And now the reason is because fintechs were doing supremely well worldwide. There weren't many listed fintechs then in India, but they were doing supremely well. Klarna or some such BNPL company, Swedish or something, it is like private equity valuations of north of $100 billion. And other companies in Brazil and elsewhere, there was some, I think, news item about Warren Buffett investing in one of those fintechs. So it all just became a real, narrative that fintechs are going to take away business from the brick and mortar. Because it's the recency bias of investors. And I don't mean, again, the end investors, but even fund managers and analysts are all susceptible to it. Now, for them, there was a massive long 10-year time period or 11-year time period that HDFC Bank outperformed. And now 2 years have been terrible years for HDFC Bank compared to the public sector banks. In 21, HDFC Bank underperformed by 41%, and in 22, 60%. And over a 3-year period, HDFC Bank is underperforming by 50%. Obviously, this also contributes to our underperformance. As I'm highlighting, we are one of our top holdings is HDFC Bank, and we don't own any government-owned banks. Now, over time, HDFC Bank has always been a very good sized holding for us, and it's delivered fantastic return. Last 2 years, it's been problematic. Now, should we jump over from year to year? I don't believe that way any money can be made. Like you see on this graph, every time there is this red zone, people would have the same question in their mind. Is it something that structurally changed and the government-owned companies would now continue to do well forever? I think as long as they're government-owned companies, and management is controlled by the government. I'm not talking about just in India. We have an EM fund. We have invested and looked at these government-owned companies across the world, from Korea to Mexico. There is a genetic problem, which is government selects the management. And as long as that is true, over long periods of time, because no government is permanent in a democracy or even an authoritarian regime. Hence, these companies don't deserve a multiple because the terminal value is highly suspect. And hence, while this has been the longest time period, we at least don't believe this is structural. Having said that, we do mitigate risk. It's for risk mitigation why we have 60% in large caps, right? We are not zero large caps, even though we believe alpha is more in mid and small. Similarly, as the weight of these companies have gone up in the benchmark, so this segment of the market, poorly governed segments of the market, has now become 25 to 30% of the benchmark. This was probably around 15% of the benchmark at the COVID bottom in March 2020, and has gone up substantially because this segment has outperformed. 15% underweight was tolerable, 25% underweight is not tolerable. And hence we have cherry-picked from the bad lot, if you will, or the poor governance lot, to mitigate the risk. And while we don't think we can generate 8 to 10% alpha in that segment of the market, but we would still, just like in large caps, we do generate low to mid single digit of alpha. We would seek to generate, at least that kind of alpha, or 2-3% alpha. So we have invested in certain. These are just the industrial names, but there are other names as well, a couple of other names as well, like BEML is another name, which are government owned, to mitigate this risk. But are we going to be overweight government owned companies? Highly unlikely. Never say never, because the governance is an important element of our investment approach since ever. Sometimes it is true that poorly governed segments of the market would do very well, but then there would come a time period like 2018. So like there would come a time period like 2018 when the poorly governed segments of the market would do very poorly. During this time period, upward sloping line, remember, means the poorly governed segments of the market are doing poorly. So there would come this time frame. You can't, nobody, just like nobody can time the market over here. Yeah. Nobody can time the market, like get out at the top and get in at the bottom. Retail investors are good at doing the reverse because of the fear factor that plays on their mind, but nobody is shown any consistency, any skill in getting in at the bottom and getting out at the top or anywhere near. Yeah. Same way, you cannot predict that government-owned companies would do better or would do worse. You have to assume that they'll do all in line with each other. However, alpha generation potential is lower in this segment of the market, and that is the reason why we don't allocate much capital over there, because the idea is to not just avoid underperformance, but the idea is to generate alpha over time. And we've done that over a 16-year time period by allocating, even with lower allocation to government-owned companies. I think the worst in this graph, I forgot to mention one thing. The worst performers are not the fixed income guys, where only 1 crore has gone to 9 crores. The worst performers are actually the people who get very nervous at the bottom and exit the market, only to re-enter. So if you look at in this slide, there are investors. I'm not talking about investors on this call, but there are investors who will be sucked into the market. Many of you would have seen the Harshad Mehta scam movie. they would leverage themselves and get sucked into the market at the top and exit. So at the top, they would believe risk hai to ishq hai and all those things, that in many ways these bulls would in media would portray, and they would tend to enter at the peak, and then at the bottom they would exit. They would tend to enter close to here because everything, and Arshad Mehta is talking about, India is as the best place in the world, and then the scam breaks out, market's gone down 50%, and then there are headlines whether the scam is 5,000 crores, 10,000 crores, 50,000 crores, whatnot, and that scares the hell out of people, and they exit. And then they come back then closer to 98, 99, 2000 time period when there's a bull market in TMT, and again, it's a new age .com and everything, and they believe the world has changed, and now equities is again structural thing, and hence, though I missed out on last many years, I will enter at the top. And again, then the bubble bursts, they get scared that it was all a bubble and exit. And then it keeps repeating. 2008 bubble, when it burst, everyone was so scared of Lehman crisis. 2008 Diwali parties, you all remember, everyone was hyper scared and exited the market because we've not even scratched the surface. Everyone was putting out targets like index would become, Sensex would become 5,000, 3,000, no end on the downside. And a year later, then, once the election was over and the market hit few circuits upward, and then finally the same investor comes back. And every time in doing so, you miss out 50% to 100%. And hence your return ends up being actually oftentimes worse than the what fixed deposit would have given. And same would be the case of fund managers who try to keep chasing what segment of the market, government sector is doing well, or the other sector is doing well, or the other sector. There's no money to be made that way. You manage the risk, which we've shown to historically manage extremely well. We are not just amongst the very top performers over time in terms of return. We're also the most consistent over time. Yeah, notwithstanding last year, including last year, we are the most consistent over time. Though last year was the most negative of the years over this time, but that doesn't change the fact that we are the most consistent over time. And hence we would not be chasing, because that chasing would not result in any other. If we had a belief, if we believed that such chasing can generate alpha, we would do that. But that kind of chasing doesn't serve anyone.
Sure. Thanks, Prashant. So Manoj, quickly a question for you on CDMOs, given that the subject to regulations. If you can just talk about the regulatory aspect governing CDMOs.
So I think, Vivek, when you talk about the regulatory aspects, I think it's a very important consideration. And given that most of the companies who works with the innovators, they do have regular inspections from their partners, I would say that until now we have seen that their regulatory standards are pretty good. And they have been able to pass most of the regulatory inspections, etc. But again, when I talk about regulatory challenges, it's not only pertaining to India. I think across the globe, whether you talk about US, whether you talk about China, a lot of companies do find these kind of regulatory issues, even in the respective country. It might be just because we do track Indian companies, and people feel that Indian companies are probably have a poor regulatory track record. But that's not the case. Even companies in the US, the largest company, even Pfizer, have got a couple of time FDA observations and FDA 483 letters.
Sure, Manoj. So we are almost past the time, but a couple of last questions. So Parag, one quickly for you. Can you quickly comment on the affordable housing finance companies?
Yeah, so I think, it's a pretty interesting space. And, it kind of, when you say affordable housing, it kind of ranges from a pure housing company at a various ticket size as well as there are companies which give you a loan for business purpose by mortgaging your house. So I think very interesting. We own one or two companies there, which are very niche, operates in a very small ticket size and with a decade of experience. What matters in this space is core competency, because housing looks very simple, but it is not so simple when you have different ticket size and when you go actually to the self-employed category and category which don't have income proofs and all, and in this segment valuations are rich, so it have to be very, very selective. And I think there are winners here, and a right combination of strength, underwriting, and selection of customer base is something very important to make money here. Vivek?
Sure. Thanks, Parag. Hi, Prashant. There are a few questions on the IT sector. Just a comment on the IT sector and valuations.
So again, valuations are to be looked in the context of the prospects and can vary. The prospects can vary from company to company. The IT sector globally, the way we think about it, if you were to the backdrop for the individual company investments, see, IT spend globally grows around 4% in dollar terms. Yeah, outsourcing grows somewhat higher because companies worldwide, Fortune 500, Fortune 2000 and beyond, they are increasingly outsourcing. So assume outsourcing grows a percentage point or thereabouts higher. Offshoring is growing somewhat faster. Which is, so one can outsource in US to companies within US, but one can also outsource to low cost or high value locations like India. So as per NASSCOM projections, Indian IT industry is expected to grow about 7 to 8% over time. Within that, these are dollar terms, remember, which is a big mistake that people think of this 7 to 8% growth and they look at other companies which are in rupee terms, say consumer staples or consumer discretionary, which are growing 10, 12%, but those are rupee terms. So when you convert dollar to rupee, over extended period of time, rupee has depreciated by 3.5 to 4%. So what is 7, 8% translates to 11, 12% in rupee terms over time. It doesn't come year after year, every year, sometimes more, sometimes like last year, sometimes less like this year. So we think that the industry would likely grow low double digit in rupee terms, 10 to 11%. Now within that, just like in financials, 12 to 15 years ago, you could have said, okay, NBFCs would grow at 15%. But there are many NBFCs which have gone bankrupt and zero and business shut down. And then you have NBFCs like Bajaj Finance, which have compounded at 30% because of fantastic, superb execution, supernormal execution. Same way in IT services, we look for companies that have executed extraordinarily. And these companies like Coforge, as an example, has outgrown most companies in the IT sector over the last several years. This year also remains to be seen, but we do expect them to be amongst the top quartile or better in terms of growth delivery. So the ROICs in the industry are very good unless you are doing any accounting, jugglery, which the team has over the last many years done a superb job at avoiding companies with poor governance and accounting, and that's the reason why in 2018 the performance was as strong as it was. So unless you're doing accounting jugglery, the business can generate strong returns, and within that we look for companies that are scaling up faster by gaining market share. Examples like Coforge, which also you saw as being one of the top contributor to performance, and we invest at valuations that we believe for companies in context of these are attractive. So right now, something like Coforge, Persistent, they are trading at low to mid 20s cash flow multiple, the OpCo multiple. We haven't gone through all that today, but as you might recollect, the way we value companies are on basis of our excess ROIC or OpCo multiple. So the market is trading at about 30 times right now. Sensex multiple is about 30 times on that metric, whereas these IT companies are all trading below that. So I believe the valuations are attractive. Yes, the near term demand environment and outlook is mixed or difficult to predict because of the potential risk of slowdown in US. And that is possibly one of the reasons why there is opportunity in some of these names at the valuations that they're trading at. Maybe we can do a rapid fire on some of the other names, on some of the other questions if we still have time.
Yeah, maybe a couple more, Prashant. So very quickly, just your view.
I see a question on InfoEdge. The ROE
Yeah.
and ROC is below 5%, and market cap to sales is more than 25, and so on. So on what basis you have this stock in the portfolio? So remember, what you have to look at is what is sustainable ROE, ROIC, and all in a given year or in a given quarter. Because of certain exceptional items, the ROIC may be lower. In any business, there could be exceptional items. Listed or unlisted business, there could be exceptional items. Even some of the best companies in India, like Unilever and others, they might take some write-off sometime or the other. I don't know whether Unilever has taken or not, but that is a possibility. So InfoEdge had to write down some of its investments recently, and that's why last year or last quarter might show low ROE or ROCE, because the R is the numerator is artificially suppressed or temporarily suppressed. Otherwise, for InfoEdge Naukri.com, which is the bread and butter, 80% of the value, they have 80% market share in the Naukri business, in the job search business. They have 60% EBITDA margin, almost infinite ROIC, because there's no capital. They take money upfront for services provided over the next 12 months. And so the ROIC there is infinite. Obviously, in certain of their businesses, they're still in the investment phase, like 99 Acres, Jeevan Sathi, and others. So those you do value separately. But even if you take the combination of these .com business on a sustainable basis, they've done extraordinarily well on ROIC, ROC. It's a name that we've owned since inception here at WhiteOak. And it was one of the top contributors, as you saw. And I have owned it at my prior firm for similar time frame as well. So it's a name that we've owned for a dozen years now, if not longer. And they are very well aware that it's an extraordinary ROIC and cash flow generating machine.
Maybe Prashant, you can talk about the global semiconductor scenario. There's a question on that.
There's a question on, please elaborate your view on the global semiconductor scenario, especially given the tension in Taiwan. So obviously, if something were to happen untoward in Taiwan, if China were to take it under some one fine morning, then there is a major disruption possibility. But a lot depends on what is the reaction by US and others, whether there are sanctions or whatnot. So there would be if some such thing would happen, the prices of semiconductors, all kinds of chips and whatnot would shoot through the roof, and then there'll be a mad rush to set up, parallel capacity in Europe, in US, and everywhere else, which already has started for diversification and these are strategic investments for countries like US and in Europe, because after having seen what happened with Russia, Ukraine, they don't want to be overly dependent on Taiwan. So it's a binary thing. If that happens, there'll be a lot of disruption and inflation in prices of semiconductor, all things related to semiconductor. If it doesn't happen, then it's business as usual, which does go through ups and downs as semiconductors hardware business. And when economy slows down, like it is right now in some of the markets like US and Europe, it is going through oversupply situation in some segments of the market. But there also are many nuances. AI related chips and equipment, they are surging, and that's why you have names like Nvidia. Even in a semicon slowdown time period, Nvidia is up more than 200% in the US, because they're at the heart of the this AI related and graphics related phenomenon.
Thanks, Prashant. I think we are now out of time, and we'll end today's webinar here. Just like to thank everybody
I want
for
to thank all of you who endured the last 2+ hours or nearly 2 hours and joined today. Any follow-up questions, please do reach out, and hopefully many of you attended last time and have, upon your request, received the copy of One Up Wall Street. If you haven't, do let us know. The copy of that session received a lot of positive feedback. If any one of you would like to hear that again, there would be a link available that our team can forward to you. Thank you all once again for your investment, for your engagement, and for participating today. Thanks much.